Question 1. Quality control measures reveal a claim submitted for damage to a vessel's main engine crankshaft. The surveyor's report indicates that a microscopic crack, present from the time of manufacture, a latent defect, gradually widened due to normal operational stresses. This widening led to a catastrophic failure of the crankshaft, resulting in significant damage to other engine components. The vessel's policy includes the standard Inchmery clause, which covers damage arising from latent defects. However, the policy also contains exclusions for damage caused by wear and tear, gradual deterioration, and inherent vice. Based on the Marine Insurance Act 1906 and common industry practice, how should the insurer approach this claim? Option A. The insurer should deny coverage, arguing that the damage is primarily caused by wear and tear and gradual deterioration, which are explicitly excluded, and the latent defect is secondary to these excluded perils. Option B. The insurer should investigate further to determine the proximate cause of the loss, considering whether the damage is predominantly attributable to the latent defect itself or to the excluded perils of wear and tear and gradual deterioration acting upon the defect, and apply the policy terms accordingly. Option C. The insurer should consider the claim covered under the Inchmery clause, as the initial latent defect is the root cause, and the subsequent operational stresses are merely the mechanism through which the defect manifested. Option D. The insurer should offer a partial settlement based on the estimated cost of repairing the latent defect, excluding the damage to other engine components, as the Inchmery clause is interpreted narrowly to only cover the defect itself. The correct answer is C. The insurer should consider the claim covered under the Inchmery clause, as the initial latent defect is the root cause, and the subsequent operational stresses are merely the mechanism through which the defect manifested. Explanation. The scenario presents a common challenge in marine insurance where the interpretation of policy wording, specifically exclusions, is critical. The professional challenge lies in accurately applying the Inchmery clause and its associated exclusions to a novel situation involving latent defects and subsequent damage. This requires a deep understanding of the policy's intent, the legal precedents surrounding such clauses, and the regulatory framework governing marine insurance in the relevant jurisdiction, assumed to be UK/CISI for AMIM. The AMIM designation implies a need for adherence to the Marine Insurance Act 1906 and relevant industry practices and guidelines. The correct approach involves a meticulous examination of the policy wording, particularly the Inchmery clause and its exceptions. It requires recognizing that, while the Inchmery clause covers damage from latent defects, the subsequent exclusions, such as those relating to wear and tear or inherent vice, may still apply if the damage is primarily attributable to these excluded causes, even if a latent defect was a contributing factor. This approach aligns with the principle of utmost good faith and the regulatory expectation that insurers will act fairly and in accordance with the policy terms and conditions. The Marine Insurance Act 1906, Section 55(2)(c), is particularly relevant here, stating that the insurer is not liable for damage caused by inherent vice or defect of the subject matter insured. An incorrect approach would be to solely focus on the presence of a latent defect and automatically assume coverage under the Inchmery clause without considering the exclusionary provisions. This fails to acknowledge that the policy is a contract with specific limitations. Another incorrect approach would be to broadly interpret the Inchmery clause to cover all consequential damage, irrespective of whether the ultimate cause falls within an exclusion. This disregards the principle that exclusions are designed to limit coverage and are a fundamental part of the risk assessment and pricing of the insurance. A further incorrect approach would be to deny coverage solely based on the existence of a latent defect, without a thorough analysis of whether the damage directly resulted from that defect or from an excluded peril that exacerbated the defect's impact. This would be a failure to properly assess the proximate cause of the loss. Professional decision-making in such situations requires a systematic process. First, thoroughly understand the facts of the loss. Second, meticulously review the specific policy wording, paying close attention to both insuring clauses and exclusions. Third, consult relevant legal precedents and industry guidelines. Fourth, determine the proximate cause of the loss, considering whether it falls within an insured peril or an exclusion. And finally, communicate the decision clearly and transparently to the insured, referencing the policy terms. Question 2. The risk matrix shows a high probability of a significant loss event for a valuable cargo vessel. The insured has reported a casualty involving potential damage to the vessel's hull and cargo. The insured is understandably distressed and seeking immediate reassurance and a swift resolution. What is the most appropriate initial claims handling procedure to adopt in this situation, ensuring compliance with regulatory requirements and ethical obligations? Option A. Inform the insured that due to the high-risk nature of the event, a fraud investigation will commence immediately, and no further communication will occur until it is concluded. Option B. Advise the insured that no action can be taken until a full technical survey report is completed and submitted to the claims department. Option C. Immediately contact the insured to acknowledge receipt of the claim, express empathy, and outline the initial steps of the claims investigation process, including the need for preliminary information and a timeline for further communication. Option D. Authorize immediate settlement of the claim based on the insured's initial report to alleviate their distress and avoid further complications. The correct answer is C. Immediately contact the insured to acknowledge receipt of the claim, express empathy, and outline the initial steps of the claim's investigation process, including the need for preliminary information and a timeline for further communication. Explanation. Scenario analysis. This scenario is professionally challenging because it requires the claims handler to balance the insured's need for prompt resolution with the insurer's obligation to investigate thoroughly and adhere to regulatory requirements. Misjudging the urgency or the extent of investigation can lead to financial loss for the insurer, dissatisfaction for the insured, and potential regulatory breaches. The pressure to settle quickly, especially in a high-value claim, can tempt a handler to bypass crucial procedural steps. Correct approach analysis. The correct approach involves acknowledging the insured's distress and the potential for significant loss, initiating immediate contact to gather preliminary information, and clearly communicating the next steps in the claims handling process, including the need for a detailed investigation. This aligns with the principles of good faith and fair dealing expected of insurers under the regulatory framework governing marine insurance. Specifically, it demonstrates a commitment to timely communication and a structured approach to claims investigation, which are fundamental to regulatory compliance and customer satisfaction. The emphasis is on proactive engagement and setting realistic expectations for the insured while ensuring all necessary information is gathered for a fair assessment. Incorrect approach is analysis. Delaying contact with the insured until a full technical report is available is an incorrect approach because it fails to meet the expectation of prompt communication and can exacerbate the insured's anxiety and financial hardship. This delay could be construed as a breach of the duty of good faith and may contravene specific regulatory requirements regarding response times for claims. Proceeding directly to a full settlement without a preliminary investigation based solely on the initial notification is also incorrect. This bypasses the insurer's fundamental duty to investigate the claim's validity and quantum, potentially leading to overpayment and a failure to uphold the terms of the insurance contract. It also exposes the insurer to significant financial risk and could be seen as negligent claims handling, inviting regulatory scrutiny. Focusing solely on the potential for fraud without initiating any communication or investigation is an incorrect approach. While fraud detection is a component of claims handling, it should not preclude the insurer from engaging with the insured in good faith and undertaking a balanced investigation. An immediate assumption of fraud without due process is unethical and likely to violate regulatory obligations to handle claims fairly. Professional reasoning. Professionals should adopt a structured claims handling process that prioritizes prompt and clear communication with the insured, followed by a proportionate and thorough investigation. This involves 1. Immediate acknowledgement and initial information gathering. 2. Clear communication of the claims process and expected timelines. 3. Conducting a comprehensive investigation based on the nature and complexity of the claim. 4. Fair assessment of liability and quantum. 5. Timely settlement or denial with clear justification. Throughout this process, adherence to the specific regulatory framework, ethical principles of good faith, and the terms of the insurance policy is paramount. Question 3. Operational review demonstrates that a vessel insured by a P&I club has been involved in a collision with another vessel. The collision resulted in damage to the other vessel and its cargo, and also caused a minor oil spill from the insured vessel's damaged fuel tank. The P&I Club is now assessing the liabilities arising from this incident, Which approach best reflects the primary scope of P&I coverage in this scenario? Option A. Emphasize the collision liabilities, as the collision is the initiating event causing damage to the other vessel and its cargo, with pollution being a consequential damage. Option B. Treat crew liabilities as the primary concern, assuming potential injury claims from the crew of both vessels. Option C. Focus on the damage sustained by the insured vessel as the primary liability to be addressed. Option D. Prioritize the assessment and coverage of pollution liabilities due to the environmental impact. Correct answer is D. Prioritize the assessment and coverage of pollution liabilities due to the environmental impact. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of the interplay between different P&I coverage types and the specific circumstances of an incident. The challenge lies in accurately identifying which aspect of the P&I cover is primarily engaged when multiple liabilities arise concurrently, and ensuring that the claim's handling and reserve setting reflect the correct scope of coverage. Careful judgment is required to avoid under-reserving or misallocating claims, which can have significant financial and reputational consequences for the P&I club and its members. The correct approach involves a thorough assessment of the incident to determine the primary cause and the most significant liabilities incurred. In this case, the collision is the initiating event, directly leading to damage to the other vessel and potential pollution. Therefore, the collision liabilities, which encompass damage to other vessels and their cargoes due to the insured vessel's fault, are the primary focus. Subsequently, any pollution arising from the collision would be considered a consequence of the collision and fall under the pollution liability coverage, which is often an extension or a specific part of the P&I cover triggered by the collision. This approach aligns with the principle of proximate cause in insurance and ensures that the claims are managed under the most relevant and encompassing coverage. An incorrect approach would be to solely focus on the pollution aspect as the primary liability. This fails to acknowledge that the pollution is a direct result of the collision, meaning the collision liability coverage is the foundational coverage that is engaged. Treating pollution as entirely separate and primary would misrepresent the sequence of events and the scope of coverage. Another incorrect approach would be to consider the damage to the insured vessel as the primary concern. While damage to the insured vessel is a significant consequence, P&I insurance primarily covers liabilities to third parties, not damage to the insured's own property, which is typically covered by hull and machinery insurance. Focusing on this aspect would divert attention from the core P&I liabilities. A further incorrect approach would be to assume that all liabilities are automatically covered without a detailed examination of the policy wording and the specific circumstances, leading to potential coverage disputes and inadequate claim handling. Professional decision-making in such situations requires a systematic process. First, clearly define the incident and all potential liabilities arising from it. Second, meticulously review the P&I Club's rules and the specific policy wording to understand the scope of coverage for each identified liability: crew, cargo, pollution, collision. Third, determine the proximate cause of the incident and the primary liability engaged. Fourth, assess the quantum of each liability and set appropriate reserves based on the confirmed scope of coverage. Finally, ensure clear communication with the member and all relevant parties regarding the coverage and claims process. Question 4. The evaluation methodology shows a vessel encountering a storm where cargo shifts, causing damage to other cargo and the vessel's structure. Subsequently, to prevent further damage and ensure safe navigation, the master jettisons a portion of the damaged cargo. The insurer is presented with a claim encompassing the damage to the vessel's structure, the damage to the non-jettisoned cargo, and the value of the jettisoned cargo. Which approach best reflects the correct methodology for assessing the insurer's liability? Option A. Treat all incurred losses and expenses as particular average, applying the policy deductible to the total claim amount. Option B. Consider the entire event as a single peril of the sea, with all resulting damage and sacrifices being recoverable as particular average, with the policy deductible applied to the aggregate loss. Option C. Classify the damage to the vessel's structure and the non-jettisoned cargo as general average expenses, and the jettisoned cargo as a particular average loss. Option D. Identify and quantify the damage to the vessel's structure and the non-jettisoned cargo as particular average losses, subject to policy deductibles, and separately identify and quantify the jettisoned cargo as a general average sacrifice. The correct answer is A. Treat all incurred losses and expenses as particular average, applying the policy deductible to the total claim amount. Explanation. The evaluation methodology shows a scenario where a marine insurance claim involves both particular average and general average elements, requiring a nuanced understanding of their distinct treatment under marine insurance principles. The professional challenge lies in correctly identifying and separating these two types of losses, as they are subject to different rules regarding their adjustment and recovery. Mischaracterizing or conflating them can lead to incorrect claim settlements, disputes with assureds, and potential breaches of regulatory compliance and professional duty. The correct approach involves meticulously dissecting the claim to identify all losses and expenses. Particular average losses are those that affect only a particular subject matter insured and are borne by the underwriter of that subject matter, subject to the policy terms and deductibles. General average, conversely, is a sacrifice or expenditure intentionally and reasonably made for the common safety of the vessel, cargo, and freight, and is to be contributed to by all parties interested in the adventure. Therefore, the correct approach is to first identify and quantify the particular average losses, applying policy conditions and deductibles, and then to identify and quantify the general average sacrifices and expenses, ensuring they meet the criteria for general average. The subsequent adjustment of the general average contribution would then follow established York-Antwerp rules and the principles of marine insurance law. This methodical separation ensures that each component of the loss is treated according to its specific legal and contractual framework, upholding the integrity of the insurance contract and regulatory expectations for fair claims handling. An incorrect approach would be to treat all losses as particular average, ignoring the principles of general average. This fails to acknowledge the fundamental distinction that general average losses are shared by all parties to the adventure, not solely borne by the underwriter of the damaged property. This approach would likely result in the underwriter bearing costs that should be contributed to by other interests, leading to an inequitable outcome and a breach of the principle of contribution inherent in general average. Another incorrect approach would be to incorrectly classify expenses that are clearly particular average as general average. For instance, damage to cargo due to a peril insured against, which does not involve a deliberate sacrifice for the common safety, is a particular average loss. Misclassifying such damage as general average would lead to an improper claim for contribution from other parties, creating an unfair burden and violating the principles of marine insurance. A further incorrect approach would be to apply the policy deductible to the entire claim without first separating the particular average and general average components. Deductibles typically apply to particular average losses. General average contributions are adjusted separately and are not subject to the particular average deductible in the same manner. Failing to make this distinction would lead to an incorrect calculation of the recoverable amount for the assured and the underwriter's liability. The professional decision-making process for such situations requires a thorough understanding of the Marine Insurance Act as applicable within the relevant jurisdiction for the AMIM exam, typically referencing UK law if not otherwise specified, and the principles of general average as codified in the York-Antwerp rules. Professionals must adopt a systematic approach. 1. Ascertain the nature of each loss and expense incurred. 2. Determine if the loss or expense qualifies as a particular average loss, applying policy terms, conditions, and deductibles. 3. Determine if any sacrifice or expenditure qualifies as a general average act, meeting the criteria of intentionality, reasonableness, and common safety. 4. Quantify each component separately. 5. Proceed with the adjustment and settlement according to the established principles for each type of loss. This structured methodology ensures compliance with legal and contractual obligations and promotes fair and accurate claims settlement. Question 5. Governance review demonstrates that a member of the P&I Club has failed to disclose a significant operational change that occurred prior to the renewal of their entry. This change, while not directly causing a recent incident, could be argued to have increased the potential for certain types of claims. The club's rules stipulate that failure to disclose material facts can lead to the denial of claims. What is the most appropriate course of action for the AMIM to take in managing this situation? Option A. Advise the member to seek independent legal counsel and await their advice before taking any action. Option B. Assume the non-disclosure was unintentional due to the member's financial difficulties and proceed with covering the claim. Option C. Conduct a detailed investigation into the materiality of the undisclosed operational change and its potential impact on the risk profile, seeking clarification from the member and reviewing all relevant documentation before making a determination. Option D. Immediately deny the member's claim based on the breach of the club's rules regarding disclosure. The correct answer is D. Immediately deny the member's claim based on the breach of the club's rules regarding disclosure. Explanation. Scenario analysis. This scenario is professionally challenging because it requires the AMIM to navigate a complex situation involving a potential breach of a P&I club's rules and the subsequent impact on a member's insurance coverage. The challenge lies in accurately interpreting the club's rules, assessing the materiality of the non-disclosure, and determining the appropriate course of action without prejudicing the member or the club. The AMIM must balance the club's need to underwrite risk accurately with the member's obligation to disclose material facts. Correct approach analysis. The correct approach involves a thorough review of the P&I club's rules concerning disclosure obligations and the consequences of non-disclosure or misrepresentation. This includes identifying whether the omitted information is considered material under the club's specific underwriting guidelines and the relevant legal principles governing insurance contracts. The AMIM should then engage in a factual investigation to understand the circumstances surrounding the non-disclosure, seeking clarification from the member and potentially relevant third parties. Based on the findings, a reasoned assessment of whether the non-disclosure constitutes a breach of the rules and warrants a claim denial or adjustment should be made, adhering strictly to the club's established procedures for handling such matters. This approach is justified by the fundamental principle of utmost good faith, uberrimi fidei, in insurance, which requires full and frank disclosure of all material facts by the insured to the insurer. The P&I club's rules are the contractual basis for the insurance, and adherence to them is paramount for maintaining the integrity of the insurance pool and ensuring fair treatment of all members. Incorrect approaches analysis. An approach that immediately denies coverage without a thorough investigation into the materiality of the omitted information and the specific circumstances of the non-disclosure is professionally unacceptable. This fails to uphold the principle of fairness and due process for the member and may violate the club's own internal procedures for claims handling. It also risks an incorrect assessment of the situation, potentially leading to wrongful denial of a valid claim. An approach that focuses solely on the member's potential financial difficulties as the reason for non-disclosure, without objectively assessing the materiality of the omitted information to the risk being insured, is also flawed. While financial distress might be a contributing factor, the core issue for the insurer is whether the undisclosed fact itself increased the risk of loss. This approach risks misinterpreting the cause of the non-disclosure and its impact on the insurance contract, an approach that involves immediately seeking external legal counsel without first conducting an internal review and gathering all relevant facts from the member and the club's records is premature. A legal advice may be necessary later. An initial internal assessment is crucial to define the scope of the legal inquiry and ensure that all necessary information is available. This premature reliance on external counsel can be inefficient and costly. Professional reasoning. Professionals in marine insurance management should adopt a systematic, fact-based, and rule-driven approach. This involves 1. Understanding the governing contractual terms, P&I club rules. 2. Conducting a thorough factual investigation to establish the circumstances and materiality of any alleged breach. 3. Applying the rules and relevant legal principles to the facts. 4. Communicating clearly and transparently with the member. 5. Following established internal procedures for decision-making and dispute resolution. This structured process ensures fairness, compliance, and sound risk management. Question 6. The assessment process reveals that a shipowner is seeking to ensure disbursements for a series of planned international voyages. The owner has provided a total figure for these disbursements, citing it as the sum insured. What is the most appropriate approach for the underwriter to take in assessing this risk? Option A. Conduct a thorough review of the shipowner's financial records, charter party agreements, and voyage projections to verify the quantum of disbursements and the associated risks. Option B. Focus primarily on the vessel's hull and machinery insurance policy to gauge the overall financial exposure, assuming disbursements are adequately covered within that. Option C. Apply a standard percentage of the vessel's insured value to determine the disbursement insurance amount, irrespective of the specific voyage details. Option D. Accept the shipowner's stated figure for disbursements, assuming it accurately reflects their financial exposure for the planned voyages. Correct answer is A. Conduct a thorough review of the shipowner's financial records, charter party agreements, and voyage projections to verify the quantum of disbursements and the associated risks. Explanation. The assessment process reveals a common challenge in marine insurance, accurately quantifying and ensuring disbursements. This is professionally challenging because disbursements represent a unique and often intangible financial interest, making their valuation and the assessment of risk complex. Unlike hull or cargo, which have tangible physical assets, disbursements are tied to the expectation of profit, costs incurred, and potential losses arising from the vessel's operation. The AMIM framework emphasizes a thorough understanding of the insured's business and the specific risks they face. Correct approach involves a detailed examination of the insured's financial records, voyage accounts, charter party agreements, and any other documentation that substantiates the quantum of disbursements. This includes verifying the legitimacy of expenses claimed and assessing the likelihood of the vessel completing its intended voyage or operation, which is fundamental to the disbursement's value. This aligns with the AMIM focus on prudent underwriting and risk management, requiring insurers to have a clear and verifiable basis for the sums insured. Regulatory guidelines within the marine insurance sector, as understood through the AMIM syllabus, mandate that insurers must not underwrite risks without a proper understanding of the exposure, and this includes ensuring the insured sum accurately reflects the insurable interest. An incorrect approach would be to accept the insured's stated figure for disbursements without independent verification. This fails to meet the underwriting principle of establishing a sound basis for the insurance contract. Ethically, it could lead to overinsurance, where the insured benefits unfairly from a loss, or underinsurance, where the insured suffers a greater loss than anticipated. Another incorrect approach is to apply a blanket percentage of the vessel's value to disbursements, ignoring the specific operational context and financial projections of the voyage. This is a superficial assessment that does not address the actual insurable interest and risks associated with disbursement, potentially leading to mispricing of the risk and inadequate coverage. A further incorrect approach is to focus solely on the vessel's physical condition, neglecting the financial and operational aspects that define the disbursement risk. Disbursements insurance is not a proxy for hull insurance. It covers a distinct set of financial exposures. Professionals should approach disbursement insurance by first understanding the insured's business model and the specific voyage or operation. This involves requesting and meticulously reviewing all supporting financial and contractual documentation. The insurer must then critically assess the reasonableness of the claimed disbursement quantum in relation to the expected outcome of the voyage or operation. This analytical process, grounded in evidence and a thorough understanding of marine commerce, is crucial for sound underwriting and compliance with industry, best practices, and regulatory expectations for responsible risk management. Question 7. Market research demonstrates that clients often seek to minimize insurance premiums by opting for the most basic cargo cover available. You are an associate in marine insurance management, tasked with advising a client who wishes to insure a shipment of electronics from Asia to Europe. The client explicitly requests the use of institute cargo clauses, C, to reduce costs, stating they believe this is sufficient. However, your initial assessment suggests that the nature of the cargo and the transit route present moderate risks of damage from perils such as heavy weather and accidental damage during handling, which are more comprehensively covered under institute cargo clauses, B or A. Which of the following approaches best aligns with your professional responsibilities and the regulatory framework governing marine insurance management? Option A. Immediately agree to the client's request for institute cargo clauses. C. To secure the business and maintain client satisfaction, assuming the client is aware of the coverage limitations. Option B. Explain to the client the specific risks that institute cargo clauses, C, do not cover. Highlight the potential financial implications of these exclusions for their specific shipment, and recommend either institute cargo clauses B or A based on your risk assessment, while documenting their final decision if they still choose ICC-C. Option C. Agree to the client's request for institute cargo clauses C, but make a note in your internal file that the client insisted on this cover, without explicitly communicating the limitations again to the client during the policy issuance process. Option D. Refuse to offer institute cargo clauses, C, coverage for this type of cargo, informing the client that only institute cargo clauses B or A are acceptable options, without further discussion of their cost concerns. The correct answer is B. Explain to the client the specific risks that institute cargo clauses, C, do not cover. Highlight the potential financial implications of these exclusions for their specific shipment, and recommend either institute cargo clauses, B, or A based on your risk assessment, while documenting their final decision if they still choose ICC-C. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's desire for cost savings and the underwriter's duty to ensure adequate and appropriate coverage, adhering to regulatory requirements and ethical principles. The underwriter must balance commercial pressures with their professional responsibility to provide sound advice and manage risk effectively. The correct approach involves a thorough assessment of the cargo's nature, value, and transit risks, followed by a clear explanation to the client of the implications of selecting a lower-tier institute cargo clauses, IC, cover. This approach upholds the underwriter's duty of care and professional integrity. By recommending the most suitable ICC cover based on a risk assessment and clearly articulating the trade-offs, the underwriter acts in accordance with the principles of good practice expected of an associate in marine insurance management. This aligns with the overarching regulatory expectation that insurance products are sold appropriately and that clients are not misled into inadequate coverage, even if it means a higher premium. The underwriter's role is to advise on risk management, not solely to facilitate the cheapest option if it compromises essential protection. An incorrect approach would be to immediately agree to the client's request for ICC-C clauses without further investigation. This fails to meet the duty of care and could lead to a significant claim shortfall for the client, potentially exposing the underwriter and their firm to reputational damage and regulatory scrutiny for mis-selling or inadequate advice. It prioritizes the client's immediate cost concern over their long-term risk protection. Another incorrect approach would be to dismiss the client's request outright, without understanding their rationale or exploring potential risk mitigation strategies. While the underwriter has a duty to advise appropriately, a complete refusal without discussion can alienate the client and may not be the most constructive way to manage the situation. It fails to engage with the client's stated objective, even if that objective is based on a misunderstanding of the coverage implications. A third incorrect approach would be to agree to ICC-C clauses, but fail to document the client's explicit instruction and the underwriter's advice regarding the limitations of this cover. This creates a significant gap in professional record-keeping and leaves the underwriter vulnerable if a claim arises that would have been covered under ICC-A or B, but is excluded under ICC-C. It neglects the importance of clear communication and documentation in managing client expectations and potential disputes. The professional decision-making process for similar situations involves a structured approach. 1. Understand the client's objective and underlying concerns. 2. Conduct a comprehensive risk assessment relevant to the cargo in transit. 3. Educate the client on the different levels of ICC cover and their implications for various risks. 4. Provide a clear recommendation based on the risk assessment and client's needs. 5. Document all discussions, advice given, and the client's final decision, especially if it deviates from the recommendation. 6. Ensure the policy wording accurately reflects the agreed coverage. Question 8. Strategic planning requires that upon discovering a significant hull breach on a vessel at sea, the vessel's owner, who is the insured party, immediately considers their obligations and the potential for recovery of expenses. The owner has several options for responding to the situation. Which of the following responses best aligns with the principles of sue and labor expenses under a marine insurance policy? Option A. The owner decides to abandon the vessel to its fate, assuming that the hull insurance will cover the total loss of the vessel, and therefore no immediate action is necessary to mitigate further damage. Option B. The owner waits for instructions from the insurer before taking any action, even though the situation is deteriorating and further damage is imminent. Option C. The owner immediately engages a specialized salvage company to tow the vessel to the nearest safe port, incurring substantial costs without prior consultation with the insurer, believing the insurer will cover all expenses. Option D. The owner instructs the crew to make temporary repairs to stem the ingress of water, while simultaneously notifying the insurer of the incident and seeking guidance on the most appropriate course of action to minimize further damage and protect the vessel. Correct answer is C. The owner immediately engages a specialized salvage company to tow the vessel to the nearest safe port, incurring substantial costs without prior consultation with the insurer, believing the insurer will cover all expenses. Explanation: this scenario is professionally challenging because it requires the marine insurance manager to balance the immediate need to mitigate further loss with the insurer's ultimate financial responsibility and the contractual obligations outlined in the policy. The manager must exercise sound judgment to ensure that actions taken are reasonable, necessary, and ultimately recoverable under the sue and labor clause, without incurring unnecessary expenses or acting outside the scope of their authority. The correct approach involves the insured taking all reasonable steps to minimize the loss and protect the insured property, and then promptly notifying the insurer of the incident and the actions taken. This aligns with the fundamental principle of sue and labor, which is to prevent further loss and protect the insured interest. The insurer is then obligated to reimburse the insured for reasonable and necessary expenses incurred in these efforts, as per the policy terms and established marine insurance principles. This approach is ethically sound as it upholds the contractual agreement and fosters a collaborative effort to manage the loss. It is also regulatorily compliant as it adheres to the spirit and letter of the sue and labor clause, which is a standard inclusion in marine insurance policies and is implicitly or explicitly governed by the regulatory framework underpinning marine insurance in the relevant jurisdiction, assumed to be UK/CISI for AMIM. An incorrect approach would be for the insured to take no action to mitigate the loss, assuming the insurer will cover all damages regardless of the insured's efforts. This fails to uphold the insured's duty to minimize loss and would likely be a breach of policy conditions, leading to a denial of sue and labor expenses. Another incorrect approach would be for the insured to undertake extensive and disproportionate salvage operations without consulting the insurer, incurring costs that are not reasonable or necessary in relation to the potential loss. This could lead to disputes over the recoverability of expenses, as the insurer's liability is limited to reasonable and prudent actions. A third incorrect approach would be for the insured to abandon the property without attempting any salvage or mitigation, thereby failing to fulfill their obligations under the sue and labor clause and potentially voiding their claim for sue and labor expenses. Professionals should approach such situations by first understanding the specific terms of the sue and labor clause in their policy. They should then assess the situation, identify immediate risks, and determine the most reasonable and cost-effective steps to mitigate further damage. Prompt and clear communication with the insurer is paramount, providing details of the incident and the proposed actions. Any significant expenditure should ideally be discussed and agreed upon with the insurer beforehand, where practicable. This systematic approach ensures that actions are aligned with policy obligations, regulatory expectations, and ethical responsibilities, fostering a transparent and efficient claims process. Question 9. Quality control measures reveal that a recent training module on the history of marine insurance has presented a skewed perspective on its development. Which of the following historical developments, if emphasized as the primary driver of marine insurance's evolution, would represent the most significant misinterpretation of its foundational principles and their ongoing impact on modern underwriting and claims management? Option A. The gradual codification and universal acceptance of the principle of utmost good faith, uberimi fidei, through legal precedent and custom. Option B. The establishment of Lloyd's of London as a central hub for marine insurance underwriting and information exchange. Option C. The introduction of steam-powered vessels and their impact on the types and frequency of maritime perils. Option D. The direct influence of major historical naval conflicts on the pricing and availability of war risk insurance. The correct answer is A. The gradual codification and universal acceptance of the principle of utmost good faith, uberimi fidei, through legal precedent and custom. Explanation: scenario analysis. This scenario presents a professional challenge in understanding the historical evolution of marine insurance principles and their impact on modern underwriting practices. The challenge lies in discerning which historical developments are foundational and continue to influence current regulatory frameworks and ethical considerations, as opposed to those that are merely anecdotal or have been superseded. Careful judgment is required to connect historical context to contemporary professional responsibilities within the Associate in Marine Insurance Management (AMIM) framework. Correct approach analysis. The correct approach correctly identifies the development of the utmost good faith principle as a foundational element that directly impacts current underwriting and claims handling practices. This principle, originating from early maritime customs and codified over time, remains a cornerstone of marine insurance law and practice globally, including within the regulatory scope relevant to the AMIM exam. Its emphasis on full disclosure by the insured and honest representation by the insurer is a continuous ethical and legal requirement, directly influencing how policies are underwritten, premiums are set, and claims are processed. This historical development is not just a matter of academic interest, but a practical imperative for AMIM professionals. Incorrect approaches analysis, an approach that focuses solely on the introduction of steam power in shipping as a primary driver of marine insurance development, overlooks the fundamental contractual and ethical underpinnings of insurance itself. While technological advancements certainly altered risk profiles and necessitated adjustments in policy terms and premiums, they did not fundamentally change the core principles of disclosure and good faith that were already being established. This approach is incorrect because it prioritizes a technological shift over the evolution of the insurance contract's ethical and legal framework, an approach that highlights the establishment of Lloyd's of London as the sole determinant of marine insurance development is also flawed. Lloyd's played a pivotal role and was instrumental in standardizing practices and fostering a market. It was not the exclusive locus of development. Marine insurance principles evolved through various legal cases, legislative actions, and the practices of numerous insurers and brokers across different maritime nations. Attributing the entire development to a single institution oversimplifies a complex, multifaceted historical process and ignores the broader legal and commercial influences. An approach that emphasizes the impact of specific historical naval battles on the pricing of war risk insurance, while factually relevant to specific periods, fails to capture the overarching, continuous development of core marine insurance principles. While battles certainly influence the perception and pricing of particular risks, the fundamental principles of utmost good faith, insurable interest, and indemnity, which are the bedrock of marine insurance, developed more gradually and broadly. This approach is too narrow and focuses on a consequence, war risk pricing, rather than the foundational principles that govern all aspects of marine insurance. Professional reasoning. Professionals in marine insurance management should adopt a historical perspective that prioritizes the evolution of core principles and their enduring impact on current practices and regulations. This involves understanding how fundamental concepts like utmost good faith, insurable interest, and indemnity have been shaped by historical events, legal precedents, and market practices. When evaluating historical developments, professionals should ask, does this development represent a fundamental shift in the contractual obligations, ethical standards, or legal framework of marine insurance that continues to influence our work today? This analytical framework allows for a discerning approach, separating foundational principles from incidental or superseded historical details, thereby ensuring compliance with current regulatory expectations and ethical standards. Question 10. Strategic planning requires a marine insurance manager to assess a vessel that has suffered significant damage. The assured is eager to declare the vessel a total loss to receive the insured value promptly. The manager, however, has received preliminary survey reports suggesting that, while the damage is severe, the cost of salvage and repair might be close to, but potentially not exceeding, the insured value. The manager must decide how to proceed with the claim assessment, which approach best aligns with professional and regulatory obligations. Option A. Inform the assured that due to the uncertainty and potential for repair, the claim is unlikely to be settled as a total loss and suggest they proceed with repairs at their own expense. Option B. Recommend that the assured abandon the vessel to the insurer, thereby forcing the insurer to accept it as an actual total loss regardless of the repair costs. Option C. Immediately declare the vessel an actual total loss as requested by the assured, to expedite the claim settlement and maintain a positive relationship. Option D. Advise the assured that based on the preliminary reports, the vessel may qualify as a constructive total loss if repair costs exceed the insured value, and initiate a formal, detailed assessment process involving independent surveyors and costings to definitively determine the loss classification. The correct answer is D. Advise the assured that based on the preliminary reports, The vessel may qualify as a constructive total loss if repair costs exceed the insured value, and initiate a formal, detailed assessment process involving independent surveyors and costings to definitively determine the loss classification. Explanation: this scenario presents a professional challenge because it requires the marine insurance manager to balance the immediate financial interests of the assured with their overarching duty to the insurer and adherence to regulatory principles governing marine insurance claims. The core of the dilemma lies in determining whether a vessel is an actual total loss or a constructive total loss, which has significant financial implications for both parties. The manager must act with integrity and diligence, ensuring that the assessment is fair, objective, and compliant with the relevant regulatory framework. The correct approach involves a thorough and objective assessment of the vessel's condition and the costs associated with its salvage and repair, strictly adhering to the definitions and procedures outlined in the relevant marine insurance legislation and industry guidelines applicable to the AMIM exam. This means meticulously evaluating whether the cost of recovering and repairing the vessel exceeds its insured value, as per the legal definition of a constructive total loss. The manager must gather all necessary evidence, consult with qualified surveyors, and apply the established legal tests without bias. This approach upholds the principles of good faith and fair dealing inherent in insurance contracts and aligns with the regulatory expectations for professional conduct in marine insurance claims management. An incorrect approach would be to prioritize the assured's immediate desire to declare an actual total loss to expedite a payout, even if the objective evidence does not support this classification. This would be a failure to apply the legal definitions correctly and could lead to an overpayment by the insurer, violating the manager's fiduciary duty. Another incorrect approach would be to delay or obstruct the claims process in an attempt to force a settlement that is less favorable to the assured, even if the claim is valid. This demonstrates a lack of good faith and could breach regulatory requirements for timely and fair claims handling. Furthermore, accepting the assured's subjective assessment of the loss without independent verification and expert opinion would be a significant professional failing, as it bypasses the due diligence required in assessing the true extent of the damage and the economic viability of repair. Professionals should approach such situations by first understanding the precise legal and contractual definitions of actual and constructive total loss. They must then systematically gather all relevant factual information, including survey reports, repair estimates, and market values. This information should be analyzed objectively against the established legal tests. If there is ambiguity, seeking expert advice and consulting with legal counsel is prudent. The decision-making process should be documented thoroughly, demonstrating the rationale behind the assessment and ensuring transparency and accountability. Question 11. Market research demonstrates that rejection insurance is increasingly being utilized by marine cargo traders to mitigate risks associated with goods being refused by the buyer. An AMIM professional is reviewing a claim where a shipment of specialized machinery was rejected by the buyer due to alleged nonconformity with contractual specifications. The rejection insurance policy in question is governed by UK marine insurance law and the principles of the Insurance Act 2015. Which of the following approaches best aligns with the regulatory framework and best practices for assessing this claim? Option A. Conduct a thorough investigation into the specific reasons for rejection, comparing the alleged nonconformity against the contractual specifications and the policy's coverage provisions, while also considering the insured's duty of disclosure under the Insurance Act 2015. Option B. Rely on general market understandings of rejection insurance to determine coverage, without a detailed review of the specific policy wording or the buyer's specific grounds for rejection. Option C. Immediately approve the claim based on the buyer's rejection notice, as the policy is designed to cover such events. Option D. Advise the insured to pursue legal action against the seller for breach of contract, as this is the primary recourse for non-conformity issues. The correct answer is C. Immediately approve the claim based on the buyer's rejection notice, as the policy is designed to cover such events. Explanation: this scenario is professionally challenging because it requires an AMIM professional to navigate the complexities of rejection insurance, a niche but critical area of marine insurance. The challenge lies in accurately assessing the insurer's obligations and the insured's entitlements under a policy that may have ambiguous wording or specific exclusions related to rejection. A deep understanding of the relevant regulatory framework, specifically the principles governing marine insurance contracts and the duties of insurers and insureds within the specified jurisdiction, is paramount. Misinterpreting the policy terms or applicable regulations can lead to significant financial disputes, reputational damage, and potential regulatory sanctions. The correct approach involves a thorough review of the rejection insurance policy's specific terms and conditions, alongside a comprehensive understanding of the applicable marine insurance legislation and case law within the designated jurisdiction. This includes identifying whether the rejection was due to a breach of contract by the seller, a defect in the goods, or other factors that might trigger coverage under the policy. The professional must then apply these findings to the insurer's duty to indemnify, considering any deductibles, limits, or specific exclusions. This methodical, evidence-based approach ensures compliance with the contractual obligations and regulatory requirements, upholding the principles of good faith and fair dealing inherent in insurance contracts. An incorrect approach that focuses solely on the insured's assertion of a loss without verifying the underlying cause and its alignment with policy triggers would be professionally unacceptable. This fails to acknowledge the insurer's right to assess the validity of a claim based on the policy's terms and the insured's obligation to provide sufficient evidence. Such an approach could lead to the insurer wrongly paying out on a claim that is not covered, or conversely, wrongly denying a valid claim, both of which have regulatory implications. Another incorrect approach that prioritizes expediency over accuracy, such as immediately agreeing to the insured's demand for compensation without due diligence, disregards the insurer's fiduciary responsibilities and the need for a proper claims investigation. This can result in financial losses for the insurer and potentially set a precedent for future claims that is not aligned with the policy's intent or regulatory expectations. A further incorrect approach that relies on general industry practices rather than the specific policy wording and governing law is also flawed. While industry norms can provide context, they cannot override the explicit terms of a contract or the mandates of the regulatory framework. This can lead to misinterpretations of coverage and potential disputes. The professional decision-making process for similar situations should involve a structured claims assessment framework. This includes 1. Understanding the insured's claim, clearly documenting the insured's account of the rejection and the basis for their claim. 2. Policy review, meticulously examining the rejection insurance policy, paying close attention to definitions, coverage grants, conditions, warranties, and exclusions. 3. Regulatory and legal analysis, consulting the relevant marine insurance legislation, regulations, and significant case law within the jurisdiction to understand the legal framework governing the policy and the claim. 4. Evidence gathering, collecting all necessary documentation, such as contracts of sale, inspection reports, correspondence related to the rejection, and any expert opinions. 5. Coverage determination, applying the gathered evidence and legal analysis to the policy terms to determine if the rejection is a covered event. 6. Communication, maintaining clear and transparent communication with the insured throughout the process. Question 12. The efficiency study reveals that the current underwriting process for port risk insurance is perceived as slow, leading to potential loss of business to more agile competitors. Considering the need to maintain underwriting integrity and regulatory compliance, which of the following approaches best addresses this challenge while upholding best practices in marine insurance management? Option A. Focus solely on competitive pricing to attract new business, deferring detailed risk assessment until after the policy has been bound to ensure market share growth. Option B. Reduce the scope of due diligence by relying primarily on the Port Authority's submitted documentation and historical claims data with minimal independent verification to expedite the underwriting timeline. Option C. Increase the use of automated underwriting tools that generate quotes based on broad industry averages for port risks, without requiring specific analysis of individual port operational characteristics. Option D. Streamline the underwriting process by implementing a tiered risk assessment system that categorizes ports based on predefined risk profiles, allowing for faster decision-making on lower-risk applications, while dedicating more in-depth analysis to higher-risk scenarios. Correct answer is D. Streamline the underwriting process by implementing a tiered risk assessment system that categorizes ports based on predefined risk profiles, allowing for faster decision-making on low-risk applications, while dedicating more in-depth analysis to high-risk scenarios. Explanation: the efficiency study reveals a need to refine the process for underwriting port risk insurance. This scenario is professionally challenging because it requires balancing the insurer's financial stability with the insured's operational continuity, all within the strict confines of regulatory compliance. The AMIM designation emphasizes a thorough understanding of marine insurance principles and their practical application, including the regulatory landscape governing such products. Key aspect of this is ensuring that underwriting decisions are not only commercially sound, but also adhere to the principles of fair treatment of customers and robust risk management, as mandated by relevant authorities. The correct approach involves a comprehensive review of the port's operational procedures, security measures, and historical incident data to accurately assess the specific risks associated with its port operations. This aligns with the best practice of underwriting based on a thorough understanding of the risk being insured, ensuring that premiums accurately reflect the exposure and that appropriate terms and conditions are applied. This detailed risk assessment is crucial for fulfilling the insurer's duty of care and for complying with regulatory expectations that insurers maintain adequate underwriting controls and solvency margins. It directly supports the principle of underwriting for sound business and avoids the pitfalls of inadequate pricing or coverage, which could lead to financial distress for the insurer or inadequate protection for the insured. An incorrect approach would be to rely solely on the port's self-reported data without independent verification. This fails to meet the professional standard of due diligence expected of an underwriter. Regulators expect insurers to conduct their own investigations and not to take information at face value, especially when significant financial commitments are involved. Such a failure could lead to underpricing the risk, resulting in financial losses for the insurer and potentially leaving the insured inadequately covered, which would be a breach of fair treatment principles. Another incorrect approach would be to apply a standard, generic port risk policy without considering the unique characteristics and specific hazards of the port in question. This demonstrates a lack of understanding of the fundamental principles of insurance underwriting, which requires tailoring coverage to the specific risk. Regulatory frameworks often emphasize the need for policies to be fit for purpose and for insurers to understand the risks they are insuring. A generic approach risks both underinsuring the port and overinsuring it, leading to either insufficient protection or an unnecessarily high premium, neither of which is professionally sound or compliant with the spirit of fair insurance practices. Finally, an approach that prioritizes speed of placement over thorough risk assessment, perhaps due to competitive pressure, is also professionally unacceptable. While efficiency is desirable, it must not come at the expense of sound underwriting judgment. Regulatory bodies expect insurers to have robust risk management frameworks in place, which inherently includes adequate time for due diligence. Rushing the underwriting process increases the likelihood of errors, mispricing, and inadequate coverage, all of which carry significant regulatory and financial consequences. The professional decision-making process for similar situations should involve a systematic evaluation of the risk, considering all available information, seeking independent verification where necessary, and applying underwriting principles consistently. It requires a commitment to understanding the specific risk being insured and ensuring that the policy terms and premium accurately reflect that risk, all while adhering to the regulatory requirements for solvency, fair treatment, and responsible business conduct. Question 13. The evaluation methodology shows that a vessel owner is claiming for increased value, Roman 4, insurance following a partial loss that significantly impacted their ability to secure lucrative, high-value cargo contracts that were anticipated to commence shortly after the loss date. The owner has provided projections of these contracts and their associated profit margins as evidence for the Roman 4 claim. Which of the following approaches best reflects the professional and regulatory requirements for assessing this Roman 4 claim? Option A. Reject the Roman 4 claim outright, as the increased value from the contracts had not yet been contractually secured and revenue generated at the time of the loss. Option B. Accept the owner's projected profit margins without further scrutiny, assuming the Roman 4 insurance is intended to cover all potential future earnings. Option C. Apply a standard uplift percentage to the primary insured value, as is common practice for Roman 4 insurance, to determine the Roman 4 claim amount. Option D. Assess the Roman 4 claim based on a detailed review of the projected contracts, their profitability, and the likelihood of their realization, considering the impact of the partial loss on the owner's ability to fulfill them. The correct answer is D. Assess the Roman IV claim based on a detailed review of the projected contracts, their profitability, and the likelihood of their realization, considering the impact of the partial loss on the owner's ability to fulfill them. Explanation. The evaluation methodology shows that the insured's claim for increased value Roman IV insurance is being assessed. This scenario is professionally challenging because it requires a nuanced understanding of how to value potential future profits or increased market value that is not yet realized at the time of loss. The insured may have a vested interest in maximizing the Roman IV claim, while the insurer must ensure the claim is consistent with the terms of the policy and the principles of indemnity. Careful judgment is required to balance the insured's legitimate expectation of recovery with the insurer's obligation to avoid over-indemnification. The correct approach involves a thorough review of the insured's evidence demonstrating the anticipated increase in value. This would typically include market analysis, forward-looking sales projections, confirmed orders, or other objective indicators that the increased value would have materialized but for the loss. The insurer must then assess whether this anticipated value was indeed covered under the Roman IV policy terms, and if the methodology used to quantify it is reasonable and supported by evidence. This aligns with the principle of indemnity, ensuring the insured is put back in the financial position they would have been in had the loss not occurred, without profiting from the claim. Regulatory frameworks, such as those governing insurance contracts and claims handling, emphasize fairness, good faith, and the accurate assessment of loss. An incorrect approach would be to automatically accept the insured's stated valuation without independent verification. This fails to uphold the insurer's duty to investigate claims thoroughly and could lead to over-indemnification, violating the principle of indemnity. Another incorrect approach would be to dismiss the Roman IV claim solely because the increased value was not yet fully realized at the time of the loss, without considering the policy's intent to cover such anticipated gains. This could be seen as a failure to act in good faith and could contravene the spirit of the Roman IV insurance coverage. A third incorrect approach would be to apply a rigid, predetermined percentage of the primary insured value to the Roman IV claim, irrespective of the specific evidence presented by the insured. This lacks the individualized assessment required for Roman IV claims and may not accurately reflect the actual anticipated increase in value. Professionals should approach such situations by first understanding the specific terms and conditions of the Roman IV policy. They should then engage in a collaborative process with the insured to gather all relevant evidence supporting the claimed increased value. This evidence should be objectively assessed against market conditions, industry standards, and the policy's coverage scope. If discrepancies or uncertainties arise, further investigation, expert consultation, or negotiation may be necessary to reach a fair and compliant settlement. Question 14. What factors determine the appropriate sum insured for a marine hull insurance policy to uphold the principle of indemnity and utmost good faith? Option A. The lowest possible premium that can be offered to attract the business, even if it results in a sum insured below the vessel's true market value. Option B. The sum requested by the insured based on their perceived financial needs and desired coverage level, without independent verification of the vessel's actual worth. Option C. A comprehensive assessment of the vessel's current market value, considering its age, condition, and any recent upgrades, alongside the estimated cost of repairs or replacement, ensuring the sum insured does not exceed the actual value of the insured subject matter. Option D. A valuation based solely on the vessel's original purchase price, irrespective of its current market depreciation or any subsequent improvements. The correct answer is C. A comprehensive assessment of the vessel's current market value, considering its age, condition, and any recent upgrades, alongside the estimated cost of repairs or replacement, ensuring the sum insured does not exceed the actual value of the insured subject matter. Explanation. This scenario is professionally challenging because it requires a marine insurance underwriter to balance the insured's need for coverage with the insurer's obligation to uphold the principle of indemnity, while also adhering to the duty of utmost good faith. Misjudging the extent of loss or the insured's actions could lead to underinsurance, overinsurance, or disputes, all of which can damage the insurer's reputation and profitability. Careful judgment is required to ensure the policy accurately reflects the risk and the insured's potential loss, without creating an incentive for moral hazard. The correct approach involves a thorough assessment of the vessel's current market value and the cost of repairs or replacement, ensuring that the sum insured does not exceed the actual value of the insured subject matter. This aligns with the principle of indemnity, which aims to restore the insured to the financial position they were in before the loss occurred, without allowing them to profit from the insurance. Adherence to the principle of utmost good faith is also paramount, requiring the underwriter to act honestly and transparently with the insured, and to ensure the policy terms are clear and understood. This approach upholds regulatory requirements for fair dealing and accurate risk assessment. An approach that focuses solely on the insured's requested sum insured without independent verification fails to uphold the principle of indemnity. This could lead to overinsurance, where the sum insured exceeds the actual value, potentially encouraging moral hazard and violating the spirit of insurance as a protection against loss, not a profit-making venture. It also breaches the duty of utmost good faith by not ensuring the policy accurately reflects the risk. An approach that prioritizes minimizing the premium above all else, even if it means underinsuring the vessel, also violates the principle of indemnity. If a loss occurs, the insured will not be fully compensated, leaving them financially exposed. This can lead to disputes and claims of unfair treatment, undermining the insurer's reputation and potentially breaching regulatory obligations related to fair claims handling. An approach that relies on outdated valuation methods without considering current market conditions or the vessel's specific condition neglects the principle of indemnity and the duty of utmost good faith. The value of a vessel can fluctuate significantly due to market demand, age, and maintenance. Failing to account for these factors can result in a sum insured that is either too high or too low, leading to an inequitable outcome for either the insurer or the insured. Professionals should employ a decision-making framework that begins with a clear understanding of the fundamental principles of insurance: indemnity, insurable interest, and utmost good faith. This involves conducting due diligence to accurately assess the value of the insured subject matter, verifying the insured's insurable interest, and ensuring all material facts are disclosed and understood. The process should involve objective valuation, clear policy wording, and a commitment to fair claims settlement, all within the established regulatory framework. Question 15. Examination of the data shows that a vessel insured under a Standard Institute Cargo Clauses (ICE) policy has incurred a significant fine from port authorities for exceeding draft limitations, resulting in damage to the port's infrastructure. The policyholder is requesting that the insurer cover the fine imposed by the port authorities. Option A. Immediately agree to cover the fine, as it is a direct consequence of the vessel's operation and the port authorities have imposed it. Option B. Advise the policyholder that the fine is likely not covered, as it represents a penalty for a breach of regulations, and coverage for such penalties is typically excluded unless explicitly stated and the breach was not due to willful misconduct. Option C. Advise the policyholder that the fine is covered under the all risks provision of the policy, as it is an unforeseen event. Option D. Suggests that the policyholder negotiate a reduced fine with the port authorities and offer to contribute a portion of the fine as a gesture of goodwill, without admitting liability. The correct answer is B. Advise the policyholder that the fine is likely not covered as it represents a penalty for a breach of regulations, and coverage for such penalties is typically excluded unless explicitly stated and the breach was not due to willful misconduct. Explanation. This scenario presents a professional challenge because it requires an insurance professional to navigate the complex interplay between contractual obligations, regulatory compliance, and ethical considerations when faced with a potential fine levied against a policyholder. The core difficulty lies in determining the extent of the insurer's liability for a penalty that is not a direct consequence of physical damage or loss, but rather a regulatory infraction. The AMIM qualification emphasizes understanding the scope of marine insurance coverage and the principles governing it, particularly concerning liabilities that may or may not be insurable. The correct approach involves a thorough review of the specific wording of the marine insurance policy, paying close attention to clauses that define covered liabilities and any exclusions that might apply to fines or penalties. This approach is correct because marine insurance policies are contracts of indemnity, and their coverage is strictly defined by their terms. Insurers are generally not liable for fines or penalties imposed as a result of a deliberate act or omission by the assured that constitutes a breach of statutory duty or a criminal offense, unless explicitly stated otherwise. The professional must consult the policy wording and relevant case law or regulatory guidance within the specified jurisdiction to ascertain if the fine falls within the scope of covered liabilities. This requires a diligent and objective assessment of the facts against the policy terms and applicable legal framework. An incorrect approach would be to assume coverage based on a broad interpretation of loss or damage, without scrutinizing the policy's specific provisions regarding fines and penalties. This fails to acknowledge that fines are often punitive and not intended to be indemnified, as doing so could undermine the deterrent effect of such penalties. Another incorrect approach would be to deny coverage solely based on the fact that it is a fine, without a detailed examination of the policy wording and the circumstances giving rise to the fine. Some policies might, in specific circumstances, cover certain types of regulatory fines if they are directly linked to the insured peril and not a result of the assured's willful misconduct. A third incorrect approach would be to offer coverage without proper due diligence or consultation with legal counsel or senior management, potentially exposing the insurer to uninsurable risks and setting a dangerous precedent. The professional decision-making process in such situations should involve 1. Understanding the precise nature of the fine and the circumstances leading to its imposition. 2. Conducting a meticulous review of the relevant marine insurance policy wording, including all endorsements and clauses. 3. Identifying any specific clauses that address fines, penalties, or statutory breaches. 4. Consulting relevant legal and regulatory frameworks within the specified jurisdiction to understand the insurability of such liabilities. 5. Seeking advice from legal experts or senior management when the interpretation of the policy or the legal implications are unclear. 6. Communicating the decision clearly and transparently to the policyholder, providing a detailed explanation of the basis for the coverage determination. Question 16. When evaluating a claim for damage to a vessel's hull sustained during a storm, which of the following approaches best aligns with the regulatory framework and ethical obligations for an associate in marine insurance management? AMIM professional operating under UK regulations and CISI guidelines. Option A. Advise the insured that storm damage is generally covered and proceed with a preliminary payment based on their estimated repair costs, pending a full investigation. Option B. Inform the insured that hull insurance typically excludes damage caused by severe weather events and suggest they explore alternative coverage options. Option C. Conduct a thorough review of the vessel's hull insurance policy, including all relevant clauses and endorsements, and meticulously examine all submitted survey reports and evidence to determine if the damage is a direct consequence of a peril insured against. Before making any coverage determination, Option D. Immediately authorize payment of the claim to alleviate the insured's financial distress, assuming the storm constitutes a covered peril under the policy. The correct answer is D. Immediately authorize payment of the claim to alleviate the insured's financial distress, assuming the storm constitutes a covered peril under the policy. Explanation. This scenario is professionally challenging because it requires the AMIM professional to balance the insured's need for prompt claim settlement with the insurer's obligation to investigate thoroughly and adhere to policy terms and conditions, all within the specific regulatory framework governing marine insurance in the relevant jurisdiction. The potential for financial loss, reputational damage, and regulatory scrutiny necessitates a carefully considered approach. The correct approach involves a systematic review of the policy wording, relevant clauses, and the presented evidence to determine if the loss falls within the scope of coverage. This requires a deep understanding of marine insurance principles and the specific policy provisions, such as the institute cargo clauses or hull clauses, and their application to the facts of the loss. The justification for this approach lies in the fundamental principles of insurance contract law and the regulatory duty of care owed by insurers and their representatives to policyholders. Adhering to the policy terms ensures fair treatment of the insured while protecting the insurer from unwarranted payouts. This aligns with the regulatory framework's emphasis on transparency, good faith, and the proper administration of insurance contracts. An incorrect approach that focuses solely on the insured's immediate financial needs without a thorough policy coverage assessment would be professionally unacceptable. This fails to uphold the contractual obligations of the insurance policy and could lead to the insurer paying for claims that are not covered, thereby breaching their fiduciary duty to their stakeholders and potentially violating regulatory requirements regarding prudent underwriting and claims handling. Another incorrect approach that prioritizes a quick settlement to avoid administrative burden, regardless of the policy's terms, is also professionally unsound. This demonstrates a lack of due diligence and a disregard for the contractual agreement, potentially exposing the insurer to significant financial risk and regulatory sanctions for failing to manage claims appropriately. A third incorrect approach that involves making assumptions about coverage without verifying them against the policy and supporting documentation would be a critical failure. This bypasses the essential steps of claims investigation and policy interpretation, leading to potential errors in judgment and a failure to act in good faith towards all parties involved. The professional decision-making process for similar situations should involve 1. Understanding the insured's reported loss and its immediate impact. 2. Retrieving and meticulously reviewing the relevant insurance policy, including all endorsements and clauses. 3. Gathering all available evidence pertaining to the loss, such as surveys, reports, and witness statements. 4. Applying the policy terms and conditions to the facts of the loss, identifying coverage triggers and exclusions. 5. Consulting with legal or technical experts if the interpretation of the policy or the assessment of the loss is complex. 6. Communicating clearly and promptly with the insured regarding the coverage position and the claims process. 7. Making a decision based on a comprehensive and objective assessment, in accordance with regulatory requirements and ethical principles. Question 17. Operational review demonstrates that a consignment of perishable foodstuffs, insured under a UK-governed marine cargo policy, arrived at its destination showing significant spoilage. The policy contains a standard exclusion for inherent vice or defect of the subject matter insured. The insured claims for the loss, arguing that the spoilage occurred during the voyage. The initial surveyor's report notes that the foodstuffs are naturally susceptible to spoilage if not maintained at precise temperature controls, but also mentions that the vessel experienced unusually rough seas for a significant portion of the transit, which may have compromised the integrity of the refrigeration system. Which of the following approaches best reflects the professional and regulatory obligations of the marine insurance manager in handling this claim? Option A. Advise the insured that the claim is uninsurable due to the inherent vice exclusion and suggest they pursue a claim against the carrier for inadequate refrigeration. Option B. Accept the claim in full, assuming that any spoilage occurring during transit is covered, regardless of the cause. Option C. Deny the claim outright, citing the inherent vice exclusion due to the perishable nature of the foodstuffs. Option D. Conduct a thorough investigation to determine the proximate cause of the spoilage, considering both the inherent susceptibility of the goods and the impact of the rough seas on the refrigeration system, and assess coverage based on whether an insured peril contributed to the loss. Correct answer is C. Deny the claim outright, citing the inherent vice exclusion due to the perishable nature of the foodstuffs. Explanation. This scenario presents a professional challenge because it requires the marine insurance manager to accurately interpret the scope of coverage under a marine cargo policy, specifically concerning the exclusion of inherent vice. The difficulty lies in distinguishing between damage caused by an external peril, which would be covered, and damage arising from the natural deterioration or defect of the goods themselves, which is excluded. Misinterpreting this distinction can lead to incorrect claims handling, potentially resulting in financial loss for the insurer or dissatisfaction for the insured. Careful judgment is required to apply the policy terms and relevant legal principles to the specific facts of the loss. The correct approach involves a thorough investigation to determine the proximate cause of the damage. This requires examining evidence such as the condition of the goods at loading, during transit, and at discharge, as well as considering the nature of the goods themselves and the circumstances of the voyage. If the evidence points to an external peril, such as rough seas or improper stowage by the carrier, then the damage would likely be covered, notwithstanding any pre-existing susceptibility of the goods to deterioration. This aligns with the principle that marine insurance covers fortuitous losses arising from external causes, and the exclusion for inherent vice is intended to prevent coverage for losses that would have occurred regardless of the voyage. Adherence to the Marine Insurance Act 1906, as applicable in the UK/SISI jurisdiction, and established case law on proximate cause and inherent vice, is paramount. An incorrect approach would be to automatically deny the claim solely because the goods are of a type that is prone to deterioration. This fails to consider whether an insured peril actually contributed to the loss. Such an approach ignores the insured's right to coverage for losses caused by external factors and may breach the duty of utmost good faith owed to the insured. Another incorrect approach would be to assume coverage simply because the goods deteriorated during transit, without investigating the root cause. This would effectively render the inherent vice exclusion meaningless and could lead to the insurer covering losses that are not intended to be insured. This approach fails to uphold the contractual terms of the policy and the principle of indemnity, as the insurer would be paying for a loss that is not fortuitous or caused by an insured peril. A further incorrect approach would be to rely solely on the surveyor's initial report without independent verification or further investigation, especially if the report is ambiguous regarding the cause of damage. While surveyors' reports are valuable, the ultimate responsibility for determining coverage rests with the claims handler, who must ensure all relevant evidence and policy terms are considered. The professional decision-making process for similar situations should involve a structured approach. 1. Understand the policy wording thoroughly, paying close attention to definitions and exclusions. 2. Gather all relevant documentation, including the policy, bills of lading, survey reports, and any correspondence. 3. Conduct a detailed factual investigation to establish the timeline of events and the condition of the cargo. 4. Identify the proximate cause of the loss by applying legal principles and case law. 5. Consider the applicability of any exclusions, particularly inherent vice, and whether an insured peril contributed to the loss. 6. Make a coverage decision based on a comprehensive assessment of the facts and the policy terms, acting in accordance with the duty of utmost good faith. 7. Communicate the decision clearly and professionally to the insured, providing detailed reasons. Question 18. Benchmark analysis indicates that a vessel carrying a consignment of high-value electronics has experienced an unexpected surge in market demand, leading to a significant increase in the insured value of the cargo mid-voyage. The marine insurance policy is in place, and the original premium was calculated based on the initial declared value. The underwriter is now considering how to address this change in risk exposure. Which of the following represents the most appropriate professional response under UK marine insurance regulations and SISI guidelines? Option A. Inform the assured that the original premium is no longer valid and unilaterally impose a substantially higher premium for the remainder of the voyage. Option B. Calculate and charge a supplementary premium, call, reflecting the increased insured value, after consulting with the assured and confirming the revised value. Option C. Advise the assured that the increased value is not covered under the existing policy, and they must arrange separate insurance. Option D. Maintain the original premium, assuming the increase in insured value is within an acceptable tolerance for the policy. Correct answer is B. Calculate and charge a supplementary premium, call, reflecting the increased insured value, after consulting with the assured and confirming the revised value. Explanation. This scenario presents a professional challenge because it requires the AMIM candidate to apply the principles of a call system and premium calculation within the specific regulatory framework of the Associate in Marine Insurance Management (AMIM) exam, which is understood to be based on UK regulations and SISI guidelines. The core difficulty lies in discerning the correct application of these principles when faced with incomplete or potentially misleading information, necessitating a thorough understanding of how premiums are adjusted and how the call system operates in practice under these specific guidelines. The correct approach involves recognizing that the call system, as governed by UK marine insurance practices and SISI guidelines, is designed to address unforeseen circumstances or changes in risk exposure that were not fully accounted for at the inception of the policy. When a significant increase in the insured value of cargo occurs mid-voyage, the premium calculation must be revisited to reflect this increased exposure. This involves communicating with the assured, assessing the additional risk, and calculating a supplementary premium, a call, that is fair and compliant with the policy terms and regulatory expectations. This approach upholds the principles of utmost good faith, uberimi fidei, by ensuring transparency and accurate reflection of risk, and it aligns with the regulatory expectation that premiums should be commensurate with the risk undertaken. An incorrect approach would be to assume the original premium is sufficient, despite the increased insured value. This fails to acknowledge the fundamental principle that marine insurance premiums are risk-based. A significant increase in the value of insured cargo directly translates to a higher potential loss for the underwriter, and therefore, a higher risk. Failing to adjust the premium under such circumstances would be a breach of the principle of indemnity, as the insurer would not be adequately compensated for the increased risk assumed. This also violates the duty of disclosure and good faith, as the underwriter is not being informed of material changes that affect the risk. Another incorrect approach would be to unilaterally impose a substantial increase in premium without consultation or justification based on the increased value. While a call is necessary, the amount must be reasonable and directly related to the additional insured value and any associated increase in risk. Arbitrary increases are not permissible and would breach contractual obligations and regulatory expectations for fair dealing. A further incorrect approach would be to ignore the increased insured value altogether, assuming it falls within a pre-agreed margin of error or is otherwise inconsequential. This demonstrates a lack of diligence and an inadequate understanding of how changes in insured value directly impact premium adequacy and the insurer's exposure. It risks underinsuring the cargo and failing to collect the appropriate premium, potentially leading to disputes and regulatory scrutiny. The professional decision-making process for similar situations should involve a systematic evaluation of the policy terms, the nature of the change in risk in this case, increased insured value, and the relevant regulatory and ethical obligations. This includes 1. Identifying the material change in risk. 2. Consulting the policy wording for provisions related to changes in insured value or midterm adjustments. 3. Communicating proactively with the assured to confirm the increased value and understand any contributing factors. 4. Calculating a fair and justifiable supplementary premium, call, based on the increased exposure and agreed-upon rating principles. 5. Documenting all communications, assessments, and calculations for compliance and record-keeping purposes. This structured approach ensures that decisions are informed, compliant, and uphold the integrity of the insurance contract and the professional standards expected of an AMIM. Question 19. Regulatory review indicates that a vessel insured by a P&I club experienced a collision with another vessel. During the collision, several crew members sustained injuries, a portion of the insured vessel's cargo was damaged, and there was a minor release of fuel oil into the water. The shipowner is seeking to understand the extent of P&I coverage for the resulting liabilities. Which of the following approaches best reflects the regulatory framework for assessing P&I coverage in this scenario? Option A. Prioritize coverage for the damage to the other vessel involved in the collision, as this is the primary consequence of a collision. Option B. Assess coverage by reviewing the P&I club's rules specifically for crew injury, cargo damage, pollution, and collision liabilities, and determine coverage for each category independently based on the rule wording. Option C. Focus on the overall financial loss incurred by the shipowner due to the incident and seek coverage for the total amount. Option D. Assume that all liabilities arising from the collision are covered under the general collision liabilities provision of the P&I rules. The correct answer is B. Assess coverage by reviewing the P&I club's rules specifically for crew injury, cargo damage, pollution, and collision liabilities, and determine coverage for each category independently based on the rule wording. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of the P&I club's rules and the underlying marine insurance principles to correctly assess the scope of coverage for a complex incident involving multiple potential liabilities. The challenge lies in distinguishing between distinct types of liabilities, crew, cargo, pollution, collision, and determining which are covered under the P&I policy, especially when the incident has overlapping elements. Careful judgment is required to avoid misinterpreting the rules and potentially leaving the insured shipowner exposed to uninsured losses or making incorrect claims against the club. The correct approach involves a thorough examination of the P&I club's rules, specifically those pertaining to crew liabilities, cargo liabilities, pollution liabilities, and collision liabilities. This approach is right because P&I clubs operate based on their rules, which define the scope of coverage, exclusions, and conditions. Correct assessment will meticulously map the facts of the incident to the specific provisions within the rules for each category of liability. For instance, crew liabilities typically cover injury, illness, and repatriation, while cargo liabilities cover loss or damage to cargo. Pollution liabilities address environmental damage, and collision liabilities cover damage to another vessel. By systematically applying the rules to each aspect of the incident, the ship owner can accurately determine which liabilities are covered and to what extent. This aligns with the fundamental principle of insurance contracts, where coverage is determined by the policy terms and conditions. An incorrect approach that focuses solely on the fact that the vessel was involved in a collision, without dissecting the resulting liabilities, fails to acknowledge the distinct nature of P&I coverage. P&I is not a single indemnity, but a collection of specific coverages. This approach risks overlooking crew injuries sustained during the collision or cargo damage caused by the collision, which might be covered under different sections of the rules. Another incorrect approach that assumes all liabilities arising from a collision are automatically covered under a single collision liability heading is also flawed. While the rules do cover collision liabilities, often referred to as running down clauses or similar, this typically pertains to damage caused to the other vessel. It does not automatically encompass crew injuries or cargo damage sustained by the insured vessel or its cargo, which are distinct liabilities addressed elsewhere in the rules. A further incorrect approach that prioritizes the financial impact of the incident over the specific wording of the P&I rules would be professionally unsound. While financial considerations are important, coverage is strictly determined by the contractual terms of the P&I insurance. Ignoring the rules in favor of a general understanding of what should be covered can lead to significant coverage disputes and financial exposure. The professional decision-making process for similar situations should involve 1. Fact gathering. Obtain all relevant details of the incident, including reports, logs, and witness statements. 2. Rule interpretation. Conduct a detailed review of the applicable P&I Club's rules, paying close attention to the sections on crew, cargo, pollution, and collision liabilities, as well as any relevant exclusions or conditions. 3. Liability categorization. Classify each potential liability arising from the incident into the appropriate category as defined by the P&I rules. 4. Coverage assessment. For each categorized liability, determine if it falls within the scope of coverage as defined by the specific rule provisions. 5. Consultation. If there is any ambiguity or complexity, consult with experienced P&I brokers, legal counsel specializing in marine insurance, or the P&I Club itself for clarification. Question 20. The monitoring system demonstrates that a vessel experienced a fire in its engine room, necessitating the diversion to a port of refuge and the engagement of salvage services to extinguish the fire and prevent further damage. The ship owner has submitted a claim for general average, including costs for the salvage services, port charges incurred during the diversion, and crew overtime for firefighting duties. Based on the principles of general average as understood within the UK regulatory framework and the York Antwerp rules, which of the following approaches to assessing these expenses is most appropriate for an AMIM professional? Option A. Automatically allow all submitted expenses as general average, as they are presented by the ship owner in relation to a casualty. Option B. Disallow all port charges incurred during the diversion, as these are considered ordinary operational costs of the vessel. Option C. Exclude crew overtime for firefighting duties, as these are considered part of the crew's normal responsibilities. Option D. Scrutinize each expense to determine if it constitutes an extraordinary sacrifice or expenditure made for the common safety of the adventure, applying the specific provisions of the York Antwerp rules and relevant case law. The correct answer is A. Automatically allow all submitted expenses as general average, as they are presented by the ship owner in relation to a casualty. Explanation. The monitoring system demonstrates a potential discrepancy in the initial assessment of a general average event, specifically concerning the classification of certain expenses. This scenario is professionally challenging because it requires a deep understanding of the York Antwerp rules, which govern general average adjustments, and the ability to apply these rules judiciously to complex factual situations. Misclassifying expenses can lead to significant financial implications for the parties involved and can undermine the principle of equitable contribution that underpins general average. The AMIM qualification emphasizes the practical application of these principles within the UK regulatory framework, which often references the Carriage of Goods by Sea Act and relevant case law alongside the York-Antwerp rules. The correct approach involves a meticulous review of the claimed expenses against the specific definitions and allowances outlined in the York-Antwerp rules. This requires the adjuster to consider the intent and direct consequence of the expenditure in relation to the preservation of the common adventure. For instance, expenses directly incurred to extinguish a fire that threatens the vessel and cargo, or costs associated with jettisoning cargo to save the remainder, are typically allowable. Conversely, expenses that are primarily for the benefit of one party, or are a consequence of the ordinary course of business rather than an extraordinary sacrifice or expenditure for the common safety, would not be admitted. The regulatory framework, particularly through the interpretation of the York-Antwerp rules by UK courts, mandates a strict adherence to the principles of general average, requiring that sacrifices and expenditures be both extraordinary and for the common safety. An incorrect approach would be to automatically allow all expenses presented by the shipowner without critical examination, simply because they are presented as general average expenses. This fails to uphold the principle of equitable contribution and could lead to cargo owners bearing costs that are not their responsibility under the rules. Such an approach disregards the specific provisions of the York-Antwerp rules that distinguish between allowable general average expenses and operational or owner's costs. Another incorrect approach would be to disallow expenses that are clearly intended to avert a peril to the entire adventure, such as reasonable salvage remuneration paid to a third party to save the vessel and its cargo from a common danger. This would be a failure to recognize the extraordinary nature of such expenditures and their direct benefit to all parties. It would also contravene the spirit and letter of the York-Antwerp rules, which explicitly provide for the allowance of salvage charges in general average. A further incorrect approach would be to interpret the rules too narrowly, excluding expenses that, while perhaps not explicitly listed, are demonstrably incurred as a direct and necessary consequence of an extraordinary sacrifice or expenditure made for the common safety. This rigid interpretation can lead to an inequitable outcome, failing to achieve the fundamental purpose of general average. The professional decision-making process for such situations involves a structured approach. 1. Understand the factual matrix of the casualty and the expenses incurred. 2. Identify the specific York-Antwerp rules relevant to the claimed expenses. 3. Critically assess each expense against the criteria of being an extraordinary sacrifice or expenditure made for the common safety of the vessel and cargo. 4. Consider relevant case law and regulatory guidance that interprets the application of the York-Antwerp rules. 5. Document the reasoning for allowance or disallowance of each expense clearly and comprehensively. 6. Communicate the adjustment process and findings transparently to all involved parties.